Hey everyone, it's Spencer Hakimian, and welcome back to another episode of What's Moving Your Money. And happy Jackson Hole Day to all those that celebrate, especially to all those that are invested in the markets. It was a great day today. Across the board, assets rallied as Jerome Powell strongly signaled a rate cut ahead. In this episode, we are going to talk about the pros and the cons of what the Fed is doing and what we can expect over the next 12 months as it relates to these decisions about monetary policy. So stay tuned, sit back tight, and I hope you guys enjoy. So at today's Jackson Hole meeting, Jerome Powell strongly signaled that a rate cut is to be expected in September. He specifically noted a very weak job market, and he said that he personally believes that the effects of tariffs on inflation are going to be short-lived. Now, I want you guys to comment what you guys think. Do you agree with Powell's comments? I personally do not, and we're going to get into them, but I want to hear your comments. So comment here. You can look at it on my TikTok, on my Instagram, on Forbes YouTube page. I want to hear what all of you guys have to say about it. Nonetheless, markets roared. Stocks, bonds, crypto, commodities, gold, you name it, it was up in an instant. Markets rallied on the news that Powell was confirming rate cuts. The only asset class that was falling, and I believe for good reason, was the dollar. And the dollar was falling because we are going to expect lower real rates here in the United States. And on top of it, we are strongly beginning to get into territory where it is questionable how much monetary policy is truly independent here in the United States going forward. But in the short term, let's just cover that we are going to be cutting rates. The front end of the yield curve is going to be falling. We are not so sure what will happen to the back end of the yield curve. As you guys remember, last year, Powell cut rates by 100 basis points and the long end of the yield curve went straight up. Mortgage rates went up. Borrowing rates for the real economy went up as a result of those rate cuts. So it is no guarantee that borrowing costs will actually come down due to this. But again, this helps asset prices in the short term because asset prices to an extent are based off of risk-free rates. And if risk-free rates go down, everything else can get bid up a little bit further. So that covers the good stuff. And now let's get into some of the negative effects that we are potentially seeing here. So we saw the dollar rapidly fall immediately after Powell's comments. Now, that is practically important right now because as the dollar falls, our imports become even more expensive. And this is at a time where we are having significant price pressures on our imports from all the tariffs. Retailers like Walmart and Target just yesterday said that they are expecting tariff rates and prices to go up all second half long due to the tariffs. Toyota said that their prices in the US have to go up. They can no longer absorb these costs. So the dollar weakening is acting as a secondary price pressure to all these imports that are already being pressured from tariffs. And we know we have an inflation problem right now. So this can actually make the problem worse, and it is felt immediately because FX changes on the spot. FX doesn't take 6 months to pass through like how tariffs do. FX changes happen today. If you go tomorrow morning to Paris, your trip will be more than it was if you went last week because the dollar fell today. It is immediate. One other thing that I think is very important that we have to keep an eye on is with a weakening dollar, our exports should begin to do better. But we have not seen any signs yet that that is happening. We have not seen our exports grow significantly on an annualized basis or on a month-over-month basis. We just have not seen it yet. With the upcoming Christmas shopping season, it will be critical to see how our exporters perform. Don't forget, we don't just export goods as a country. We also export services. Facebook, Instagram, Google, all of these tech companies, OpenAI, these companies export their services to the world. So a weakening dollar should help them. But we have to see if it actually goes through. Economics, yes, you can read about it in a textbook, but we also really care about the real world implications. So we're going to have to wait on that. And I guess we will see. But again, let me know what you guys think in the comments about that. To close out today's episode, I just want to briefly talk about what lies ahead in the coming weeks. As we get some government data in on inflation and on the jobs report and on import and export prices and on home prices, we have to start considering that a lot of this data may be subject to further revisions in the coming months. And as it is subject to revisions, the Fed is going to react to that. We now know that the Fed is very sensitive about the weakening job market. Just in a few weeks, we're expected to get our annual revision to the payrolls report, not the monthly revision, the annual revision, and that could show close to 1 million less jobs gained in 2024 and 2025 than we had originally expected. So look, as these data points come in, it's going to be interesting seeing the tug of war in markets between, yes, weaker jobs data is going to mean more rate cuts, most likely. But weaker jobs data also means a weaker economy, right? How bullish is that really in the long term if we are cutting rates because our economy is weakening, right? In 2007, we began rapidly cutting rates. And for everyone that wasn't around back then, 2007 was actually a very good year in markets because of the same idea that rates were being cut, and that was good for asset prices. And then finally, in 2008, people caught on as to why rates were being cut, and the narrative completely switched from rate cuts being bullish to rate cuts being very bearish, because rate cuts are a symptom of a bigger cause, which is a weakening economy. So as we get into the fall, as traders get back to their desk, as the Europeans get back from their August holiday, as markets pick up around the world, I am curious to see, does this bull market sustain, or do we begin to price in some of the growth risks that are clearly baked into the picture here? Powell explicitly says they're cutting because of a weakening job market. That is very different from cutting because they think policy is a little bit too strong. They are cutting because they see a weakening job market and they need to offer some monetary support to try and offset it. So I'm going to leave it at that, and I hope you guys have a great weekend, and I'm going to see you on Monday. And as always, please tune in, please subscribe, please like, it helps a lot, and thank you guys for watching.